Solvency ratio, it is a ratio between the assets and liability. Cost of goods sold is equals to sales minus gross profit. In debtor turnover ratio, we calculate the number of days or month taken to collect the money from debtors. Debt collection period is equals to number of months or days in a year divided by debtors turnover ratio. Operating profit ratio is equals to operating profit divided by net sales into 100. Hello everyone, I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the session 2 of Unit 2, Subject Accounting. In the last class, we have discussed about ratio analysis. In today's session, let us continue with the remaining ratios in this session. In today's session, let us discuss with solvency ratio, activity ratio and profitability ratio. So first one, solvency ratio. Solvency ratio, it is a ratio between the assets and liability. So solvency ratio, it measures the ability of the concern, ability of the firm to meet its total liability out of total assets. That means to calculate solvency ratio, we consider total assets and total liability. It measures the ability of the firm to meet its liability over assets. So this is the ratio. More the solvency ratio, more the financial soundness. So the more solvency ratio represents the soundness of your business concern. Next, turnover ratio or activity ratio. Turnover ratio are those ratio which measures the operational efficiency of the organization. Which measures the operational efficiency of the organization. It reflects the efficient use of resources to generate the profit. Then it is also termed as performance ratio because it measures the performance of different operation. It measures the performance of different operations. It reflects the number of time the stocks have been rolled out. Then the frequency of debt collection period. So the regular time period to collect the debt and frequency of creditors payment, the time taken to repay the creditors. Then cash turnover ratio. It enables the management to make decision about the speedy movement of stocks, debt collection, creditors payment and many other such operational aspects. That means this turnover ratio helps the management to take necessary decision whether to increase the debt collection period and creditor payment period as well as stock turnover period or stock turnover ratio. It helps the management to take necessary decision. Under turnover ratio or activity ratio, first one, stock or inventory turnover ratio. It can be calculated using cost of goods sold divided by average stock. Cost of goods sold is equals to sales minus gross profit. All this information are available in the trading and profit and loss account of the business. That means the financial statement of every business. Here sales means net sales. Net sales is equals to total sale minus sales return. Here sales is equals to net sales. Net sales means total sales minus sales return. Then gross profit. In the trading account, we will get from the sales, you are going to deduct the purchases, or else from the direct income, you are going to deduct the direct expenses. Result of direct income and expenses is gross profit. Next, average stock. To calculate average stock, we will consider opening stock plus closing stock divided by 2. Average means opening stock plus closing stock divided by 2. The results of cost of goods sold plus average stock we are going to consider to calculate stock turnover ratio. Stock turnover ratio means it is expressed in times. The results of this calculation is expressed in time. For example, from the calculation of cost of goods sold divided by average stock, we get 3.41. It will expressed in number of times. That means in one financial year, 3.41 times your stock is turned over or turned off. So, in a year, 3.41 times your stock is turned over. So, it is expressed in number of times. So, this is stock turnover ratio. Next, debtors turnover ratio. Basically, debtors turnover ratio means time taken to collect the money from debtors. That means if you made a sale on credit basis, the debtor takes some period or time to repay the money. So, in a year, how many times or how many days are taken to collect the money from debtors? The frequency of debt collection period. To know the frequency of debt collection period, we need to calculate debtors turnover ratio. It can be calculated by taking into consider annual credit sale, net annual credit sale divided by average trade debtors. Net annual credit sales, for this total sales means sales minus sales return. Next, average trade debtors. Average trade debtors is equals to opening debtor plus closing debtor divided by 2. So, the results from this total sales minus cash sales divided by opening debtor plus closing debtor divided by 2 is equals to debtors turnover ratio. So, this debtor turnover ratio means to know the number of days or month taken to collect the money from debtors, you are going to calculate debtor turnover ratio. Next, creditors turnover ratio. In the same way, for debtor turnover ratio and creditors turnover ratio are similar. Here, creditor turnover ratio is calculated to know the time taken from the creditors to repay the money or time taken to pay the money back to the creditors. For this, net annual credit purchase divided by average trade creditors. Net annual credit purchase is equals to total purchase minus cash purchase. In a similar way, total purchase means purchase minus purchase return. For this, total purchase means purchase minus purchase return. Then average trade creditors is equals to opening creditor plus closing creditor divided by 2 is equals to average trade creditors. Here, net annual credit purchase divided by average trade creditor is equals to creditor turnover ratio. So, here we will get the answer, the number of days or month taken to repay the money to the creditors. Next one, debtor turnover ratio. In debtor turnover ratio, we calculate the number of days or month taken to collect the money from debtors. Here, debt collection period means you are going to calculate in number of days or month. For example, if you want debt collection period in number of days, you are going to consider days in a year. Then, if you want the result in number of months, you will consider number of months. Debt collection period is equals to number of months or days in a year divided by debtors turnover ratio. For example, if you want the result or the answer in number of days means you will take 365 divided by debtor turnover ratio. For example, debtor turnover ratio is 4.16 means 365 divided by 4.16. Or you want the results in number of months. You will take 12 divided by 4.16. In the similar way, for the debt payment period. Debt payment period means number of days or month taken to repay the money. Number of days, 365 divided by 4.16 or 12 divided by 4.16. So number of days or months. It is expressed in number of days or months. So this is all about debt collection period and debt payment period. Next, working capital turnover ratio. Working capital turnover ratio can calculate by taking net sales divided by working capital. We know net sales. Net sales means total sales minus sales return. Net sales is equals to total sales minus sales return. Working capital. To calculate working capital, current assets minus current liability. Current assets minus current liability is equals to working capital. So the result from net sales divided by working capital is working capital turnover ratio. Next, fixed assets turnover ratio. Fixed assets turnover ratio is calculated using net sales divided by fixed assets. Net sales divided by total fixed assets. Next, current assets turnover ratio. Current assets turnover ratio is equals to net sales divided by current assets. Here, current assets is equals to debtors, stock, bills receivable, then cash in hand, cash at bank, short-term investments. All this together will call current assets. The total current assets, net sales divided by total current assets is equals to current assets turnover ratio. Next ratio is profitability ratio. Till the current assets turnover ratio, it is turnover ratio or activity ratio or efficiency ratio. Turnover ratio can also be called as efficiency ratio. Turnover ratio can also be called as efficiency ratio. Next one, profitability ratio. Under profitability ratio, first one, gross profit ratio. Here, gross profit ratio. To know the gross profit percentage, gross profit ratio is equals to gross profit divided by net sales into 100. Gross profit is equals to net sales minus cost of goods sold, or else gross profit directly we can get it from trading account. The result from trading account is gross profit. So we can consider the gross profit from trading account or you can get the gross profit from net sales minus cost of goods sold. So gross profit is equals to net sales minus cost of goods sold. Gross profit divided by net sales into 100. It is expressed in percent. Next, net profit ratio. Here you will consider net profit. Instead of gross profit, for the net profit ratio, you will take net profit for this calculation. Net profit is equals to gross profit plus non-operating income minus operating and non-operating expenses. Nothing but from the profit and loss account, we will get net profit at the end. From the profit and loss account, we will calculate the net profit. We can consider that net profit, or else you can consider the gross profit plus non-operating income minus operating and non-operating expenses. Next, net sales. We know net sales is equals to total sales minus sales return. It is also expressed in percent. Next one, operating ratio. Operating ratio or operating cost ratio. It can be called as operating cost ratio. Operating or operating cost ratio is equals to operating cost divided by net sales into 100. Next one, expense ratio. Expense ratio is equals to specific expense divided by net sales into 100. Specific expense means you want to know the exact percentage or expense percentage for the salary. For the month of January, the salary expense. You need to know the percentage of salary expense. So for that, you will take the specific expense. In this, you will take the total salary divided by net sales into 100. Here you will get salary expense. To calculate the expense ratio for a particular expense, you will consider the total expense, total specific expense divided by net sales into 100. Next, operating profit ratio. Operating profit ratio is equals to operating profit divided by net sales into 100. Operating profit is equals to net profit plus non-operating expenses minus non-operating income. So, from this we will get operating profit. Operating profit divided by net sales into 100 is operating profit ratio. It is also expressed in percentage. Next, return on capital employed ratio. Return on capital employed ratio is equals to return on capital employed divided by capital employed into 100. Here, return on capital employed is equals to operating profit or EBIT. That means earning before interest and tax. EBIT. For this, operating profit means in the earlier calculation, in this operating profit ratio, we'll calculate this operating profit, right? So, net profit plus non-operating expenses minus non-operating income. The result of this is considered as operating profit for this. Return on capital employed is equals to operating profit or EBIT. EBIT means earning before interest and tax. Next, capital employed. Capital employed is equals to owner's fund plus long-term borrowings minus goodwill and fictitious assets. For example, equity. For example, equity, debt, like that. For owner's fund plus long-term borrowings minus goodwill and fictitious assets is equals to capital employed. It is also expressed in percent. Next, earning per share. Earning per share ratio is equals to earnings available to equity shareholders divided by number of equity shareholders. Earnings available to equity shareholders, then number of equity shareholders. If you want to know the number of equity shareholder, there is no information available about the number of equity share. If they have given the number of the total equity capital and face value. Total equity capital and we know the face value of each share, but we don't know the number of equity shareholders. So that we can calculate 10 lakh divided by 100. 10 lakh divided by 100. 10,000 equity shares. So, we can calculate by taking into consider the total equity capital and face value. So, 10,000 equity shares. Earning available to equity shareholders divided by number of equity shareholders is equals to earning per share ratio. Next, price earning ratio. PE ratio. PE ratio is equals to market price per equity share divided by earning per equity share. So, by taking into consider this market price, then earning per equity share, that is EPS, earning per share. So, this is all about profitability ratio. So, in this session, we learn the solvency ratio, turnover ratio and profitability ratio. In the last session, we have discussed about liquidity ratio. So, in the next session, let us continue with some more problem on the ratio analysis. Until then, keep watching. Thank you.